Hello, everyone. Good morning, good afternoon from wherever you are joining. Thank you so much for joining in and welcome to our India Factoring Chat Show, Factoring One Stop Solution for Your Global Aspirations. I am Rajesh Stogi, your host for the chat show today, and we have an eminent speaker today for our chat show. But before that, let me tell you a little more about India Factoring first. India Factoring offers working capital solutions through the factoring product aimed at converting your receivables into cash. The company is a subsidiary of a European bank, FimBank PLC, Malta, and is registered with the RBI as an NBFC. India Factoring is also 83 category authorized dealer. We started our operations in India in 2010 through our global network. We offer one-stop solution around receivables finance. We are number one in export factoring in India since 6 years. In addition to that, we have been recognized with various national and international awards like Best Receivable Finance, Top 25 Safe Places to Work, FCI Best Deal of the Year, and many more. We have our eminent speaker, Mr. Tushar Butch, as a seasoned leader professional today available with us. He currently spearheads operations at M1 Exchange, an RBI regulated trades platform. With over 38 years at State Bank of India, including roles as General Manager and CEO, and a dynamic stint at SBI Global Factors Limited, he is a trailblazer in trade finance. His expertise extends globally, having chaired the Factors Association of India and served on the FCI board. In 2021, he set to channel his leadership experience to mentor emerging corporate leaders in banking, supply chain finance, and holistic banking. We welcome you, sir.
Thank you very much, Rajeshri.
A very good morning, sir. It's pleasure to have you over here.
Thank you very much. And the pleasure is mine, first of all, to come on a chat show with leaders in two-factor model of factoring in India, namely India Factors. And it's really a matter of pride, to see an organization in India supporting the small and medium exporters to reach out to new markets in a safe environment. It's really a pleasure, to interact and to be associated in any way with India Factor. I mean, India Factors has really done well consistently, as you mentioned in the slide, for 6 years. So, it's really happy to be here.
It's a delight, sir, to hear such kind words from you. We have our audiences, being joining. So let's not let them wait, and let's directly jump on some of the few interesting topics we would be discussing today on trade finances, export financing, etc. So I would like to
Sure.
initiate.
Rajesh, just before that, a quick check. Is the audio quality okay? Am
Yes,
I
sir.
audible? Fantastic. Now
Yes, sir.
let's go ahead and jump into
You're
it.
absolutely right.
Yeah,
Right, sir.
let's jump into it. Yeah.
We do understand that TREADS is a great initiative which helps MSMEs to improve their working capital by allowing to receive funds upfront. But I still would love to know what TREADS is all about and how do the guys operate. So if you can just show some shadow over that as well.
Okay. I always love to tell the story on how the trades emerged. I will just be very brief. That when Dr. Raghavan, he took over as a governor of RBI. In his very first speech, the what is known as the 100 baby steps speech, one of the points in those amongst those 100 was the concern for timely available of liquidity and credit to the MSMEs. And he says, I wish there were an electronic platform where the MSME vendor could simply discount his invoice and get his money and be on with his, liquidity. He says this is the greatest challenge in Indian economy. And taking this, this was just an aspirational statement. It was not until 2016 that something happened, further on this. And what happened was that the Reserve Bank of India finally came out with a scheme and invited expression of interest from various tech firms and various financial institutions to set up a platform whereby this vision could be made into a reality. And that is where, six parties were shortlisted. M1 Exchange, I'm happy to say, was one of them. And after going through the expression of interest and making various compliances, we finally were awarded the license along with other two parties, but we were the first one to get the license in March 2017 to set up this digital marketplace for MSME vendor factoring. So that's how the M1 Exchange Trades platform came into being.
That's really great. So that's a story like a lot of us didn't knew about all about as well. So that's pretty great to know. So as we discuss about trades as well, which is actually a key financing solution, we also cannot miss upon another financing arrangement, which is known as factoring. So, which brings me to again a question that what do you think? Like, how does factoring impact cash flow in a business? Like, what are the key considerations for companies when deciding to use factoring as a finance strategy? So, what are your views on this as well?
A great question, because on trades we'll be combining both these factoring as well as the technology. So it's better to
Right.
understand what is factoring first, the fundamentals. A great question, Rajeshri. Uh, Look, basically, the factoring is a very, very simple, common sense method of bringing about liquidity into trade. Now, anyone who wants to sell his goods wants to have his money first, and anyone who wants to buy goods wants to pay the last. This is fundamental. This is a human trait.
Right.
Uh, so, as the trade finance, as a trade and commerce evolved over the years, and especially the cross-border trade, there was mutual suspicion on both sides that will I get the goods which I actually ordered? Will I get, and the seller will say, will I get the payment really, or will the buyer, after consuming my goods, say, bye bye, tata? So, in this, seesaw, several trade finance instruments emerged. And depending on the instrument, the risk, the seesaw went either on the seller side or on the buyer side. But the most standardized products that emerged over the long run were letter of credit. What the documentary letter of credit tried to do was to balance the equation. That on behalf of the buyer, his bank would issue an unconditional undertaking that if the goods supplied and the documents to the goods supplied were exactly in accordance to the letter of terms stated in the documentary letter of credit, then the buyer's bank would assure the payment as per the terms. So this was the first instrument came. However, no instrument is, a complete, panacea for all the ills that we are suffering. So,
Exactly.
documentary letter of credit suffered from two disadvantages. One, it involved administrative time link. Number two, the bank who wanted to issue this documentary credit on behalf of the importer or the buyer would demand sufficient collateral security or some kind of assurances that the payment would be honored by the buyer. So all this led to, and then there were economies like if I from India would go to my bank and issue a letter of credit, would some buyer in would some seller in USA or Taiwan be sure about the quality of my bank and the stability of my
Exactly.
bank? So all various such things were there. So while it was a great solution, but it was not a perfect solution, and a large part of the buyers and sellers, both sides, remained out of the purview of this arrangement. So what remained? So the second option was that okay, documents against acceptance without a letter of credit, merely on acceptance, merely on trust, you do it. Now this works. I'm not saying that this doesn't work. This works because if there is a buyer getting a consistent particular component or particular set of chemicals or particular set of goods from a known supplier, he would not like to upset this apple cart. He would like to pay his on time. He would like to make his honor his commitments and be done with it. So this was the second option. But still, it involved, issue of a documented credit and, mailing of the documents by the seller to the buyer, buyer acceptance coming, and then, when the Swift system came in, advising the acceptance over Swift. So this again was not accessible system for all and sundry. A large majority of small traders were still, looking for a fit right solution, and that is where the factoring comes in. So, is it okay if I tell something more about factoring and how it fits this gap between and balances the risk between the buyer and seller?
Absolutely, sir. Absolutely.
Fantastic. Thanks, Rajeshri. Uh, so factoring was a very common sense arrangement where uh, normally, typically a traditionally weaker seller, his risk would be passed on to the buyer. How did it happen? Because this seller would sell his receivables to an intermediary known as a factor. A factor was nothing but a banker or a factoring company or anybody, a financier. And what was the guarantee that the financier, why did the financier part with the money to the seller on immediately? Because the seller assigned his receivables by means of a legal document known as a deed of assignment
Yep.
in favor of the factor, and the notice thereof was served on the buyer that on the due date you shall be discharged from the obligations under this contract if and only if you pay the factor as per the terms of the contract. So this essence was a factoring, passing on the risks from a relatively weaker, by weaker I mean financially weaker, or a more risk prone seller to the buyer. This is what the factoring was all about. And then we shall see down the road how this factoring concepts were brought onto the trades and how it was completely made into even a more smarter product.
So you're on point, bang on. So actually, that was my next question only, which you actually answered. That how what are your views on the India factoring and how you are like how factoring can aid exporters to address the issue of delayed payments and have a very good cash flow, because one of the key things which a lot of exporters face is the cash flow concern. Like they have a rotating cash flow cycle. So that was one of the issue, and you were bang on that question. So another question which a lot of people have, that are there any specific traits or characteristics which renders certain businesses to have an engaging factoring transaction? Like, is there any particular industry which you think that that suits factoring, or it's like it's for everyone? So what are your views on that?
Okay, it is factoring is not no industry restricts factoring. Let me tell you what that. But yes, there is a kind of a transaction flow for which factoring is ideally suitable. And what is that? First of all, they should be trade transactions and not transactions for purchase of capital goods. Because typically capital goods, have a very long repayment cycle. For example, if somebody wants to import a turbine from, let's say, Suzlon, okay, a 2.5 kilowatt turbine, wind turbine. Now that would cost several crores of rupees, and the payment thereof would be from generation of the wind energy and the revenues thereof. So it's spread over a period of time. Similarly, there could be long-term leasing arrangement, where the rents are paid over a period of and 5-year long lease. So these are not typically amenable for factoring. So what is amenable to factoring? It's, let's say, a constant bilateral trade between two parties, the buyer and the seller. Let's say a garment manufacturer in Tirupur. He keeps getting orders for, let's say, the cotton shirts or for the knitted t-shirts that he makes from Gap or JCPenney USA. And this is an ongoing transaction. So one characteristic for which factoring is suitable is there should be an ongoing business relationship and ongoing supply of goods and between two parties. So that is the first condition. So A, it should be a trade transaction and not a capital good purchase transaction. B, there should be a continuous flow. And why this continuous flow is suits, I mean, why factoring, this is a sort of a precondition or a ideal condition for factoring is that it is possible, that in course of a trade, that in one consignment, the buyer may not be happy with say one quality, or maybe he was saying that okay, I asked you for 1,000 t-shirts, why did you send me only 900? Such small kind of commercial, very commonplace trade disagreements, or things could happen. What if there is a continuous relationship? What happens is that in the next consignment, in the next set of invoices, this could be adjusted, by a debit note, credit note, and so nobody is at a loss perpetually or for good. Whatever is the loss in one invoice could be made up in the second invoice. So the continuous trade relationship, helps ensure. And once there is a continuous trade relationship, like I told you just a little while earlier, nobody would, like to get out of an arrangement, particularly a buyer who has, seeded his reliable and loyal customers who provide him the quality inputs. He would never like to dispute or spoil that arrangement for the sake of one invoice or one transaction. So that ensures that
Exactly.
the arrangement goes on satisfactorily. I think we have a question coming in. Shall we take that?
Yes, sir, surely. So, Ashima writes, like, for businesses new to international trade, what advice would you give regarding export financing strategies? So, I suppose this topic is something we'll be obviously covering, but you're like possibly you can answer this at this
No,
point
so
as well.
Ashima, if you don't mind, shall we take it up in the sequence? We will
Yes,
definitely address your question. Rashid, would you note that question, or how shall we come back to it?
definitely.
So that,
Definitely, we'll have this question noted.
okay, you please note it so that,
Okay.
before the
Yes,
talk
yes, sir.
ends, we will
Sure,
see to it that Ashima's query is answered. Thank you, Ashima, for the question.
sure. Sure. So as we discussed about credit financing, trade financing, and a lot of things, and we recently actually moved on to 2024. So a lot of people are very optimistic regarding this year, 2024, because a lot of people are saying that this year interest rate would be corrected, right? Like which is again music to the ear. India entering the JP Morgan Global Bond Index, right? So there are a lot of lot of optimism which has been flowing among the population. But I would like to understand from like experts like you, like how do you anticipate the global economic growth in 2024, and like what factors do you think like will be contributing to this outlook?
First disclaimer, I am not an economist, and I cannot, I'm neither I'm a clairvoyant. So I would like to take things as they come. However, having been in the market and having been in the finance industry, I would just like to make some general statements which come to me out of common sense or anecdotal evidence, that yes, the whole globe has been undergoing a high rate regime for quite a long time. Such a long time that we have not been used to in the past 20, 30 years.
Right.
Uh, so why has this happened? The root of this, of course, was that even before we could have got completely over the 2008-10 credit crisis, in 2020 we got another crisis in form of COVID, which was even more crippling because practically the whole global trade slowed down and stopped for, I think, almost 12 months completely, and that has put us back and put us behind. So all the countries are, if we see from the India point of view, uh, like India was exporting to, let's say, the European markets, the UAE, the African markets. So each of those markets had a demand slump, and at the same time, each of those markets were facing rising inflation. So the central banks of those economies, started taking some kind of a corrective action through monetary policy instruments. And in fact, you would have noticed, Rajeshri, there was in fact a very great coordination between the all the central banks of major economies in the world. For example,
Right.
If US government raised the rates of interest in their economy, Bank of England, ECB, the RBI, the Tokyo, every economy issue simultaneously follow the suit and raise the interest rate, because everybody knows now that the flow of money is global. So if one central bank doesn't respond, the flow would come from one economy to the other and again upset the designs of the central bankers and their monetary policy. Having said all this, theoretical and what has actually happened, let me now say a few sentences about what is future. So the future also seems to be there were little shoots, green shoots of fresh economic growth reported globally. And really speaking, I would say that the US economy mercifully has not completely slowed down. In fact, it remained quite resilient. Unlike Europe, which has gone down, the US remained fairly stable and resilient. However, there were the black swan events, the Ukraine war.
Yes.
Who thought that this it could have lasted so long? And as if that was not enough, some trouble has begun in the Middle East. So the world is, as you know, the VUCA times. We are going through this, the VUCA era. So it's very difficult to say how it will go. But from the intentions as stated by the central bankers across the world, it seems that the regime of rising interest rates is going to end maybe sooner than later. So in 2024, we could see the rationalization of interest rates gradually, and with that, the investment cycle will boom, and hopefully that should promote global trade. But the political events, nobody has over control over that. And the most recent we saw was the choking of the Red Sea route and the Suez Canal. And look what it has done to the world. The costs of goods, say imports of to India, which would normally come from Europe to India through the Suez Canal route, and now to come around the Cape of Good Hope, and the costs have gone up, and the timeliness of supplies has also gone a little bit out of schedule. So all these we have to live up with these realities. But the best and the most heartening and the positive side is the way the Indian economy is, developing itself, and the way the internal demand and way the the industry majors and the government infrastructure spending is going. We are the biggest, one of the best hopes to the whole world. So that way, I would say that yes, 2024 we should see better times than what we see in 2022 and 2023. If that
Right.
is, I don't know how accurate, but that is how I would like to see the situation.
That's what I also think, sir. But as you mentioned about the VUCA world, right? So the VUCA, the
Yeah.
C is like the complexity is something which is on a high scale, right? And when I also think is like when you talk about complex, the first word which comes to my mind is sustainability. Like this is something which a lot of people are trying to figure out at these times, because India is very new to the sustainability factor. Like the norms are being adjusted right now. It's not in place at the moment, and especially ESG kicking in. A lot of companies are trying to abide to those laws. One of the questions which actually come to my mind when I talk about sustainability as well, which I actually like to know in detail about you, is like in response to environmental concerns, right? Uh, what role is sustainability playing in shaping the economic policies and the business strategies in 2024? Like, I know, I understand that, possibly India is a newer player into this, in this sustainability scenario. But what do you think, like going on forward, what do you think, how would sustainability will shape the business strategies in totality?
If you want, Rajeshri, your generation and the next generation to see the earth as it is, there is no choice except to, accept these hard prescriptions. There is no choice. There is no question of should we or should we not. How soon should we, try to reach the goal of zero emission? You're right in saying that the emerging economies had a real bad deal because the economies which really spoiled the whole global the climate warming are the ones who are better off now. The way the Americans guzzled gas, and the Chinese, when they were their economy was growing, they drove the big cars, gas guzzlers, and they spoiled the ozone layer. I mean, but we can't help it. We are all connected, and no matter who did the excesses when, but all of us will have to cooperate and do it. The challenge before India is that okay, we are now trying to propel our infrastructure growth. What are the basic ingredients of this growth? We need energy. We need our steel and cement. We need our resources and manpower. Resources and manpower, yes, that is the first place where we can, adopt the ESG norms by reforming our education system so that, we make it more eco-friendly. We bring in the eco sensitivity right in our education system. But as far as the infrastructure inputs are concerned, I mean, we are still very, very reliant on thermal power, which is
Right.
causing our leading to pollution and global warming and carbon emission. But we can't help it. So maybe we could produce this thermal power and put some better effluent controls. But beyond that, we can't do anything till our solar, wind, and these recyclable and renewable energy sources, come in place. So it's going to be a slow process, but we have to be completely mindful. And I'm very happy to know that the PLI scheme of Government of India, that they have given special attention to the green energy, and we have seen a lot of new companies coming into solar and wind energies to supplement our dependence on petroleum energy, on hydrocarbons. And with the new technology coming in, the use of hydrogen, that could completely change the things very quickly. So all is not hopeless. In fact, we could contribute more towards zero emission faster than what the goal we have set as per the international accords, beginning from the Paris Accord.
Right.
I do not
Right.
know
Great.
whether I
Great.
was able to address your question, or did
No,
I go
sir.
off track?
So I suppose this question is meant to go off track only because none of us actually understands and knows what is going to be the future in this case scenario. We all are actually adapting to this. So I do understand. And especially when you said this VUCA world, right? So this VUCA world is literally very ambiguous. Like everything happens so uncertainly, and it's so dynamic out there. One of the key things which I would like to also add on here is like supply chain, right? What I think is lately after the pandemic as well, like if India has grown to such a scale, especially if I look at industries like D2C, direct to customer, they have actually gone up just because supply chain is sorted, or India is actually growing towards like there's a hype just because of the supply chain. uh, and we also we recently saw that there are also concerns on the other hand, like Red Sea concern, which we saw that which actually is rephrasing the whole supply chain mechanism. uh, I would like to understand from you at this time, like since we are living in this VUCA world, we have a lot of geopolitical and economic changes, right? And for supply chain to work efficiently, we need to have enough funds, which we call as supply chain finance. So what do you think, like does this do this geopolitical economic changes would have any effect on the future of supply chain finance? Would they would it change how the whole financing is done, or like how it would be done?
Great question, because it has an eye on the future. So thank you for asking this,
Right.
Rajesh. See, there are two aspects. One is the supply chain in terms of physical supplies of goods and services. And the other
Right.
is making adequate finance available, or making newer ways of finance available to ensure that the financial systems don't remain are not highly capital intensive. Now, I'll try to explain what I mean. Let's see traditionally the banking. It is a very capital intensive way of financing uh, the trade activity. As I said before, most of the trade cannot even access it because the banks are constrained to keep the costs high and set some sanction standards, so they cannot reach to that. And that is where, a silent revolution has been taking place since about, let's say, 2015-16. First, a lot of broad level things happened. So that is why today we are able to talk so confidently about supply chain finance. So what happened in India? One was the India Open Stack. Through the Aadhaar and PAN mechanism, a lot of things are now to verify the authenticity of the trade or authenticity of the entrepreneur. A lot of documents are available in the public view. Then came the GST. Was the most, very significant development because uh, whenever there was a small entrepreneur or a small trader, he did not have access to very great accounting and financial skills. So his
Right.
balance sheet was typically treated with mistrust by the financiers. But because of the open stack, because of the GST, because of the access to the credit bureaus, because of the so many other public things that have come in the public domain, people started assessing the cash flow and the capability of a entrepreneur to repay the borrowings based on the cash flow earnings and not just based on a balance sheet, which was a very static year-end statement of account. So the assessment became more dynamic, and tools to assess this dynamic things were available, and plus came the fintechs. It was very interesting, Just the other day I was reading a statement from our Minister of State for Information Technology, Mr. Rajiv Chandrasekhar. In 2012, so that is just about 11 years, 12 years ago, not far away, he had tabled a paper in the parliament which said that 90% of the finance from formal sources, the banking sources, was being accessed by about just 10 to 15 top business houses in India. So nothing remained for the smaller and medium enterprises and the micro enterprises. And this is where the fintech revolution, has stepped in to address this effectively. But before I talk about fintech, or even while I talk about fintech, later on in the conversation, I would like to specifically mention how the threads brought in a fantastic revolution and has changed and shaken up the things quite a lot in the area of supply chain finance. So, how would you
Right.
like to carry on further from this stage? I mean, what should we take up? Because I think we have got about now 20 minutes time left.
Right, sir. So, sir,
So
I
we will,
have
what we'll try to do is we'll wrap up in another 5, 7 minutes and leave good 10 minutes for the questions. Will that be okay,
definitely, sir.
Rajshri? Yeah.
Definitely, sir. Definitely, sir. I have a little bit of questions more aligned for you because we literally, we did not get a hold of you. You are majorly traveling, but I literally want that, you answer some more questions. So I have one of the major question in like, for example, uh, uh, the risk part, right? So as you mentioned again, the VUCA world, a risk mitigating the risk is one of the key factors prevailing in this era, right? I want to understand this, like how business effectively can manage the risk associated with supply chain, and there are a lot of disruptions. How supply chain financing could possibly, mitigate the risk, and strategies like factoring could also play a very major role among these. So if you can just show some shadow on this as well.
Okay. So where do the risks emerge from? One is risks of goods or services physically not being delivered. And why not being delivered? Either because the enterprise has simply, the supplier enterprise has simply caved in and failed because it could not withstand the recessionary forces. Two, physical movement, like the wars or political upheavals or such events preventing the physical supply. So these are the definite risks. The risks are of economies, caving in altogether. We have seen so many economies, in India, for example, we have got the sovereign rating system that anybody wants to do business international, they rate the first country's risk based on political and the economic climate. So many countries which were, moderately risked and fair risk, they have been downgraded to, low risk and high risk areas. So this is one important thing, which has happened. Now the second part is, the risk of non-payment. So that is the credit risk, the pure credit risk. And the third is, of course, the risk of the operational risk because of the new regulations and the new awareness of the world coming to access to personal data. So data security laws and regulation is coming in a very big way. So this is another risk, the operations risk. But how this is being mitigated? Let's not, I mean, I will not like to restrict only to factoring because factoring can work beautifully because something fundamental has happened in the economy. So let's talk about one
Right.
or two fundamental factors. Uh, so first is the technology. With the use of technology, it is now possible with a reasonably more certainty to ensure to find out whether the entity is genuine, whether the supplies are genuine, whether the quality of invoice or what is stated in the invoice is genuine. So use of technology has considerably helped us in understanding these aspects and de-risking it. In India, it is very easy to know whether an invoice is genuine or no, because if the GST stated on the invoice, whether it is matched by the GST returns, the e-invoicing is coming compulsorily in a certain category of goods. So that envisages the movement of goods. So this is all de-risking. But the way factoring is done, especially the FCI model which India Factors follows, it's a very simple logical thing that India Factors is a member of FCI. FCI is a global chain of factors. There are 400 members. If I want to, a seller in Ludhiana wants to export his product to, let's say, even a country as far away as, let's say, uh, Argentina, there'll be a factor, an FCI member of Argentina, who will say, yes, this fellow is a genuine user of goods, and I provide a cover for, let's say, $1 million. Now, after the bank in Argentina providing this credit cover, there will be the political risk, which cannot be ruled out. But at least the credit risk is, considerably ameliorated because there is a factor there who knows the buyer in their currency, in their country, and who gives a certification in form of a credit cover. So this removes the credit risk to a great extent. However, in any business, it will always be eyes and ears open, and the businessmen are very prudent. They frequently visit the good old methods, the traditional methods that know your buyer, know your customer. They will go and visit him. They'll meet him at trade fairs. And global travel has also become so easy now. It's possible to do these checks either every time or as an exception, but it's very easy to achieve all these ends. So, following the prudent, good old business strategies that know your customer, know that he's genuinely in the business, try to get your own market intelligence, whether he is strong, weak, or currently under a dip. So all those things, are always there. But to top of it, technology and trade structures in supply chain are only facilitating it further and making finance available. This availability finance is a crucial thing. If time permits, I would like to touch upon that also.
Definitely. So we have a quite few questions aligned for you. I suppose we could start taking that.
I'm sure.
Ashima asks that for businesses new to international trade, what advice would you give regarding export finance strategies?
Go slow, know your customer.
Okay.
I mean, very common sense, the first things, but having done that, try to source finance, trade finance from avenues like factoring or something, where uh, the whole system is tested for over 50 years now. FCI is 54 years old. Uh, so there is a counterpart in the buyer's economy who gives your factor, your export bank, assurance that yes, this person is good for, let's say, $1 million, $2 million, $3 million. So these are the practical things, Ashima. I hope I have answered your question.
Sure. Uh, Another question which we have aligned for you is like uh, 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 if you can just understand if there any difference between factoring and invoice discounting, because both have been used interchangeably in trade and
Right,
SCF. So which is
right,
beneficial for sellers, which is asked by Shabri.
right. Uh, Great question. Basically, factoring involves uh, the financing of the whole receivables book, the sales ledger, by a factor. So what it means is that any invoices issued under the arrangement are paid for by the factor. Whereas the invoice discounting would generally refer to a system, a more traditional system, where a bank or a financier under a sanctioned line of credit would require that an invoice is backed by a bill of exchange, which is drawn according to the Negotiable Instruments Act, and where the drawer drawee are, the obligations are decided under some, either the acts like the Negotiable Instruments Act if you are in India, or internationally under the uniform rules for negotiation or uniform rules for collection formed by the ICC, the International Chamber of Commerce, under their document number 500, 600, 700, and that series. So, whereas factoring is a continuous process which doesn't require much of documentation, it is very easy to operate. The discounting would require a pre-sanction of a limit by a bank or a financier. And from the purpose of financial books of accounts, factoring is not a loan. It is just trade payables or trade receivables. Whereas discounting under a limit by a bank would necessarily come under a loan. So that is a finer accounting difference.
Great. So we again have a question aligned for you, sir. Ashish asks, can you discuss the role of export credit agencies and their impact on export financing?
I will do this because not that I'm very qualified to do this, but because of my recent interaction with some of the EPCs, the Export Promotion Councils in India. Uh, so with whom we have done a few roadshows together and addressed that. So what they do is, this is a very important step by the government of India, that for each of the products or commodities, there is an export promotion council. And this export promotion council goes to the members, understands their needs, uh, shows them the opportunities in the overseas markets, that look, here this requirement is there, or based on the trade flows of India generally, let's say India's export generally go to A, B, C country, 50%, 10%, 5%, 25%. So they discuss and share this information. So which is very necessary. Plus, they conduct road shows. They go to the visiting the other countries and meet their trade counterparts there, and form out some agreements also to honor each other's drawings on. So they play a very important role. Uh, In this regard, again, I would like to bring to you the latest that was announced, I think, by our Commerce Minister, Mr. Piyush Goyal, that he is floating a portal. Uh, what was that portal name? Let me just refer to my page. Yeah, the Trade Connect e-platform. It provides facilities to the exporters to know what is going on in the other market, the lead, the database of the buyers overseas. But all said and done, this is just information sharing. Ultimately, when you supply the good or service and you have to collect your money, that is where the risk comes, and that is where no matter what, you have to take some different risk mitigation measures.
Right. That's great.
So
So
export
we
promotion
have,
to, in one sentence, if I can say, yes, the export credit promotion councils, they are a very good marketing platforms. They disseminate information, and export credit agencies, they cover your risk, but then it is not a panacea for all your risks that you take. There are better ways to safeguard yourself. Yeah, sorry.
right, that's great. So we have another question from Shailendra. Like, please shed some light on the export of services or as how they can be factored and funded.
Okay. Before going to export, I'll first go on the trade of services. If you don't
Right.
mind, Shailendra, I would like to
Sure.
elaborate. Uh, when the trades platform came, the first thing that the trades was we did was that we do not only factor invoices for goods, because we know that as the economy becomes more advanced, the tertiary sector, that means the provision of services, also increase. So the invoices representing rendering of services are also a factorable commodity. Now, having done this in the domestic scenario, in the international services, if you see, what is the biggest service that is exported from India? It is nothing but the IT e-services, the IT related e-services. And IT related e-services have a very a different way of evidencing the rendering of service and accounting for that and financing of that. But it is generally not a very commonly associated or a factorable product as I understand it. But then now the services have gone beyond just ITE services. There are services for construction, facility management, uh, so many other, the EPC contracts where a lot of services go, and some of them could be factorable, especially even on the export side. But in the domestic, on the trades, yes, we do it in a big way. And some of the biggest, I would not like to name them here, but some of the very well known service providers in India are factoring their, I mean, they have their vendors' invoices factored on the trades platform.
Right. Great. And we have one last question from Vinod, right? So it's a pretty big one, but what I was able to understand that what Vinod is trying to say is like, why should India restrain from using the fossil fuels and the coal and etc. stuff, like as other countries are also using, and they are not like the contribution of greenhouse gases of other countries is way much more what India is actually at. So why should India, restrain from using these resources in terms of development? So India should also use these resources, and they should also develop. So what are your views on this, sir?
Vinod, it's a very natural kind of feedback that is coming. That look, we live frugally, we live by the book, and then why are we now expected to suffer? But I touched upon this a little while earlier. That look, today the globe, it's like a spider's web. The spider, if it is several tentacles going around to form its web, you break one and you are moving closer to your own extinction. So now is not the question of, why should we do this? It's how soon we do it. And, we start doing our part of the bargain. Because if our future generations have to see the earth as it is, there is no question of if and why. We have to start doing it. I mean, that's the reality.
Right, great. So do you want us, we have a few more questions lined up with us. Do you want us to take it further? Do you want us to answer, like, do you want to answer one or two more questions?
We can take up because we have got about 5 minutes more, but then we would like to wrap up, So we can
Okay.
take one or two
So
questions more.
possibly, one of the questions which actually I got, which I had in my mind is we talk a lot about regulations, right? And regulations actually play a very major role today in ascertaining a lot of things. I want to understand, like, how does trades navigate in regulatory challenges, and what steps are taken to ensure compliance with evolving financial regulations at trades itself? So, if you can then shed some light on that as well.
Sorry, your question was compounded. So can you just ask me again, please?
Yeah.
In the sense,
So,
there were two, three things that you have asked me. So let's
yeah.
go one by one.
So, the question is, like, first of all, how does trades navigate regulatory challenges?
Okay. Uh, Trades is a product of regulation. So there is no challenge. In fact, the regulation is a facilitator. And I will just elaborate. Uh, there were three integral parts of the trades and why the market has been so vibrant and successful. The first is the trades platforms are a regulated entity and the KYC, the know your customer, have to be followed and adhered to and got in place by a trades platform, just as let's say a bank or a NBFC would have to do for their customers. So this brings, this is a hygiene factor that you will not have, dud invoices going around because the parties placing these invoices are genuine. So that's the first thing. And this regulation has helped us. Second regulation is that the, the essence of any trade finance is a robust settlement system. And this regulation has given India a robust regulation system, a settlement system in form of the NPCI gateway. So what happens is a settlement on a digital platform with complete accuracy. We have been operating for 7 years. Each month, we do about the trades ecosystem does about 5 to 7 lakhs of invoices factored, but settlement of each and every one, there has not been a single disruption. This is a record, and this is the robustness of the system. So this has partly led to the vibrancy of the trades platform. And the third, of course, is that the marketplace concept, with one KYC of one vendor done, uh, the supplies to several other buyers need not be reinvented. He has done once his KYC with the trades platform and it is taken for granted by anybody who operates. So this, the market system, the many-to-many relationship, this is unique to trades. This cannot be matched by any other supply chain finance system. And this is globally accepted, and we as trade platforms, we are getting inquiries now from other economies also to set up similar trade platforms in their economy. So this is, so, and the final thing, that why from time to time the regulation helps the trades and brings in volumes because the government of India, it spots, the where the vendors are getting facing trouble, and they bring a regulation or a directive to ensure that those category of buyers are mandatorily have to pay their invoices to MSMEs on the trades platform. To give an example, concrete one, in 2018, the government of India came out with a regulation that every company registered with the ROC, if it has a top line of 500 crores or more, compulsory it should register on the trades, and the corollary, the unsaid portion of it, it will have to start making payments on to the MSME vendors on the trades platform. So which is why today the trades ecosystem, all the three platforms put together, have done more than close to 3 lakh crore worth of invoices have been factored on this trade system, and it is growing by leaps and bounds.
Right.
So
So,
this
sir,
is
actually,
something on the
that
trades. Yeah.
actually definitely. So that actually answers my another part as well, which was on the like how do you guys regularly maintain the compliance, and which you mentioned that the many-to-many system, which is actually very unique. It's very difficult to replicate. So that was pretty great, sir. Now, as we come to an end, we have a lot of questions, but still, like we are since we are short on time, we have to close this. So first of all, I would like to thank all of the viewers and audience who joined us for this session. We are really sorry if we were not able to answer your questions. You could possibly, go to India Factoring LinkedIn page, and you can tag us and you can ask your possible questions. And Mr. Tushar would be obviously there to answer your
Sure.
questions as well.
It was always a
Uh,
pleasure.
uh, and we are really thankful for you for joining over here. So it was a complete delight to understanding your views. As I mentioned, that it's literally very hard to get hold of you, but you allotted a whole 1 hour today for us. So it was really great having you over here, having discussions on trade financing, export financing, etc. So it was really great. So thank you so much for joining in.
Rajeshri, actually, the pleasure was mine because I was talking on a platform provided by a factoring company in India, and factoring is very, very dear to me. And plus, my chat show host today was a young person like you, So, my entire hopes, India hopes, is on your generation. So it's a real pleasure to interact with you, and I hope I was able to demystify some of the concepts.
No, sir, you would actually bang on a lot of pointers, not some, but you would actually bang on all the pointers, and possibly the audience will also have enjoyed a lot hearing out your thoughts. So,
Let's see, let's wait for the feedback because it will help us improve our future interactions. So yes, the bouquets and
definitely,
brickbats all are welcome. Only then we can improve our presentations.
definitely, sir, definitely. So here the show comes to an end. So thank you so much. We'll actually meet you once again in another chat show where we'll be discussing another insightful discussion, and we'll meet again. So thank you so much. Thank you for joining in. See you.